Corporate finance practice problem using OneNote. Warrant gain versus stock gain with the same investment amount. Get ready, it's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side, Practice Problems tab, down in the 1929 Warrant gain versus stock gain, same investment amount tab. Also note, when using OneNote, look at the Immersive Reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top, calculations on the right, and on down below. We're looking at our warrants once again, thinking about a situation in the future where we don't exercise the warrant, but we want to think about what the gain is on the warrant and compare that then to the stock. So we're not exercising the warrant this time. We're comparing and contrasting the increase in value of the warrant versus the stock. So our information, we have the investment amount. We will once again assume the same investment amount of the $3,965 in this case. That meaning then we're going to be purchasing a different amount of warrants and stocks, given the fact that, of course, the stocks are going to cost more than the warrants. So the first option, we purchase shares costing $65 of the stocks, and we're going to say that the shares can be purchased. For, we're going to calculate this out. This is going to be the $3,965 divided by the $65 cost. That means we can buy 61 of them. So we're going to be buying either 61 shares at the 65, or we can purchase warrants that have a cost of the warrant of $23, allows the purchase of one share. So one warrant allows the purchase of one of the stocks with an exercise price of $40. That $40, of course, being below. So if we just had the warrant and we're able to exercise it, we'd be able to exercise them for $40 instead of the current price, which is the $65. But if we bought them right now, we got to pay $23 for them. We're going to assume that after time passes, the stock price will be at $75 versus where we're starting here at the $65 market price, and the speculation premium will be down to 0 on the warrants. Okay, so we're going to say then the number of warrants that can purchase is going to be the investment amount, that same $3,965, assuming the same for the stock and the warrants. We can purchase the warrants at $23. So then, of course, we've got the $3,965 over the 23 gives us the number of warrants that we can purchase at the $172.39. We do have to deal with the fraction here as we go through our example problem. So we're then going to say that the gain on the stock, if we're going to consider the gain on the stock, pretty straightforward calculation. For an individual stock, we'd have the new stock price is at the $75. We've got the cost is at $65. So it went up then, of course, by the $10. And then that 10 times the number of shares that we purchased, meaning a gain per share of $10 times 61 that we purchased, gives us a gain in total of 610. We can also think of that on a percentage basis. So if we go to a percentage basis, taking that 610, comparing it to the original investment, which was that $3,965. So we're going to take the 610 divided by the 3,965, gives us about the 15.38%. 15.38%. And now let's be considering our warrants. What's going to be the intrinsic value of the warrant? We had the $75 at the sale time, or a year later, and we're going to have the exercise price, which is still at the 40, which is given here. So that gives us a benefit between the two of the $35. So we got a $35 benefit for exercising the warrants. We can buy one warrant, so that gives us the 35 times 1, because one warrant gives us one stock, and that's going to give us the intrinsic value of $35. So then the warrant value is going to be the intrinsic value of the $35, and then we'll compare the investment to have the number of warrants, which we calculated already, but we'll calculate it again. That gives us this $3,965, the $3,965, $23 cost per warrant. So that would give us then the $3,965 divided by the 23. So we've got the number of warrants, and again, it's a fraction, but we're going to deal with that fraction here. the 172.39 number of warrants that have an intrinsic value of 35. So we're going to say times 35, intrinsic value each having 35. And so we're going to then say the warrant value is going to be that 6,033.7. So the gain on the warrants then, if we take that warrant value that we just calculated, warrant value, and then compare that then to the investment amount, the amount that we invested, same amount that we figured we invested on the stocks, that gives us the 3,965. That means we have a gain on the warrants of the 2,068.70. Now, once again, we can compare that 2,068.70 to the gain that we calculated if we had invested the same amount in stocks, and we can see that it is higher here. So we did the last problem thinking that we exercised the warrant. Here we didn't exercise the warrant. We're just looking at the value of the warrant at that point in time. And we have that increase because of the leveraging kind of impact. Once again, remember that if you did the same kind of comparison and you were to compare, say, one warrant to one stock, then it's going to be difficult to compare the dollar amount changes because you will have then different costs for the warrant than for the stock. The warrant only costing $23, where the stock is costing the $65. But this time we had the same dollar amount that we purchased, and then we just purchased a different number of warrants versus stocks. We purchased more warrants because they're cheaper for the same dollar amount, and did that comparison, and we get to that same kind of so we could see then the increase in the gain for the warrants due to the leveraging kind of effect. So then we could do this on a percentage basis, the gain on the warrants to 2,068.70 comparing to the investment amount, that 3,965. We would get the 2,068.7 divided by the 3,965. That's going to give us then our 52.17%. That 52.17% also being greater than substantially the 15.38 on the stocks, and that is what we would be able to see even if we didn't have the same even investment amount. If we were comparing, say, one warrant to one stock, you can still compare the percent returns, which is why we have them, rather than the dollar returns, which could be deceiving if you have different amounts that are invested between the two.